Hey, welcome to this video economic analysis for February 20. On the screen in front of you, I have a price chart that I talk about in detail on today's video market analysis. It's a chart of DXY, which is the US dollar index. And I point out a number of things in more detail on the video market analysis, which you may want to go take a look at. But the point is here that the US dollar index, which measures the purchasing power of the US dollar against the currencies, I should say the purchasing power of the currencies of the 6 major trading partners of the US, you can see here that we've got a megaphone pattern as outlined by kind of the sideways funnel lines I've drawn here. And also you see that the US dollar index is at a critical point of currently support, but you can see that that line, as it often does, served as resistance prior to this point. So the question is, has the US dollar now broken out of this megaphone pattern to the downside, which also may indicate that US Treasuries will decline? So that being the case, this is the chart of US Treasuries. It's an exchange-traded fund that tracks long-term US Treasuries. You can see here, and again, I talk about this in detail on the video market analysis. You may want to go check that out as well. This is a perfect head and shoulder top here. The head and shoulder top, when measuring the distance from the head to the neckline, often projects what we can expect to the downside. So that puts our downside here at 90. So technically speaking, the setup for the US dollar and US government bonds is not great. But how does that gel with what's going on fundamentally? Well, this is a chart that shows long-term US Treasury purchases or sales by foreign central banks. The dotted line across the center of the chart here is the baseline, and you see that really from the tech stock bubble through really about 2014, foreign central banks were basically accumulating US Treasuries and US dollar-based assets. However, if you take a look at what's happened since 2014, they have been getting rid of US dollar-based assets and US government bonds significantly. Here's another chart. This information came directly from the US Treasury Department. You can see again, big change in trend. Big accumulate through 2012, big get rid of those assets since then. This is just the 12 months ending in October 2016. You can see that a lot of red ink. And if you take a look at what that's done to US government bond yields, you can see that of late, and this chart is current through January of 2018, you can see that the spread between what US Treasuries index yield is and the euro equivalent has been increasing. So despite all of Europe's financial issues, despite the fact that the European Central Bank has been engaging in their version of money printing or quantitative easing, US Treasury bond yields keep rising relative to the euros, despite all the financial trouble that they've had. That should be, fundamentally speaking, a big red flag. The rest of the world's looking at this and saying, wait a minute, we think Europe is a better credit risk than the United States. They're probably right, because when you take a look at the US official national debt, it's now approaching $21 trillion. Social Security is underfunded by $17.5 trillion. That's a total of $38 trillion, and if you divide that by the number of tax returns filed every year in the United States, that's almost $428,000 per tax return. When you hear the political rhetoric that says we're going to solve this debt and underfunded liability problem by making the rich pay their fair share, it can't be done. It simply can't be done. The math doesn't work. In fact, if you add the underfunded liabilities of Medicare to the equation, it's $123 trillion. And if you were to confiscate 100% of household wealth, you only come up with about $85 trillion. And this $123 trillion number, as big as it is, as intimidating as it is, that's not all of the underfunded liabilities. We've got to add in the underfunded liabilities of other programs like Medicaid as well. Professor Lawrence Kotlikoff says when you do that, the fiscal gap of the United States is over $200 trillion. But if we just take into account the $123 trillion number, the share per tax return is now almost $1.4 million. Bottom line is there's only 3 ways for politicians to solve this problem. They can raise taxes. I hope I've demonstrated to you that that's mathematically impossible in this short video. You can cut spending, but if you do that, you turn into a deflationary depression type economy. The only alternative to that is to print more currency, which the Fed has done. And if they do that, you'll see the US dollar and US treasuries continue to decline. And technically speaking, it looks like that's the setup. The fundamentals back it up. So what should you be doing? You should be taking a look at getting assets in your portfolio that are not US dollar based. That's today's economic update.